A lot of the things that are applicable on mutual fund traditional products, I would say from now on, because I call mutual fund traditional product and SIF product. Between the mutual fund space and the more riskier alternate space or the PMS space, even asset allocation that we say how much should people allocate to equity, to fixed income, to commodity, etc., etc. Generally a more affluent investor who has made money, who is probably in that age group where they have that much surplus to deploy. The idea is to keep getting money back every month, which PTCs allow me to do, and keep reinvesting that if levels are better. So you have the fund deck main page in front of you. Actually it talks a lot. I'll spend some time on it. Number one, our brand is RedHex for the hybrid, for the SIF strategies, right? SIF strategies sit within the mutual fund space itself. A lot of the things that are applicable on mutual fund traditional products, I would say from now on, because I call mutual fund traditional product and SIF product. So traditional products, a lot of the common things are still applicable, you can't do unrated papers, you can't do unlisted papers, you can't do non-investment grade rated papers, you can't do certain short, you can't do leveraging in this fund. Shorting is allowed, but only some percentage of shorting is allowed, not the full fund shorting, etc. So those things have been relaxed specifically for this category by mutual fund, by the mutual fund regulator. And if you see, the whole idea of this came, I think 2 to 3 years back. We were also writing papers that we want some in-between product between the mutual fund space and the more riskier alternate space or the PMS space, even for investors to take benefit of a pool of assets like a mutual fund space. But for that you needed to relax some things. So we were asking for a lot of things to regulator. Regulator finally has given some relaxations. I'll briefly talk about those things. But coming back here, RedHex is our brand. The RedHex stands for red hexagon. The hexagon is there, which is the HSBC logo, hexagon itself. The tagline is that you please get the missing piece in your core asset allocation, right? Asset allocation that we say how much should people allocate to equity, to fixed income, to commodity, etc., etc. And this we feel will be one such missing piece which I think people have forgotten for quite some time in terms of allocation. I was just talking to sir about it. It's a hybrid long-short fund. Most of the funds that have been launched till now are also in this category. There is some reason for that. One basic thing I feel is that we have the minimum investment threshold is 10 lakhs. So it is typically people who have surpluses or who have in excess of 10 lakhs who will invest here. I would think that is generally a more affluent investor who has made money, who is probably in that age group where they have that much surplus to deploy. So most of the fund houses, and this is my sense, possibly wanted to launch strategies which were mutual fund plus plus. It was not that these investors are looking to multiply their wealth. It's probably these investors are looking to protect their capital and make some additional return to protect the value of their capital, right? So inflation adjustment, etc. So that is where I think most of the strategies have got launched here. The idea of none of the funds in this category is actually to deliver something that is a 15, 20, 30% kind of a return strategy. It is more capital protection plus plus, which people are trying to offer in hybrid long short. Just as I mentioned, slots right in between, offer some flexibility on the portfolio, transparency which is similar to mutual funds, 15-day portfolios being released, valuation being done by third-party rating agencies, ICRA and CRISIL. Unlike you would say in the AIF space or in the direct exposure space, there would be no valuation. You would not know what is the value of the security on a day-to-day basis, which means if something were to go wrong, you may see that the actual value is very different from what the actual value of the NAV is. So it's a middle ground. Once again, what are the flexibilities that SIF provides? One is that you have issuer limit, which is twice of what is allowed in mutual funds. Say 10% issuer, you are allowed 20 here. You are allowed some sector limit relaxation as well. So 20% is allowed in mutual funds. In SIF, it is 5% extra, which means 25% per sector. You have shorting, which is allowed, but we are not doing any shorting in this fund. Many of the funds that have been launched also have said that we will not be shorting. The SEBI has also said that while it may be called long-short fund, you need not go short. Short means for us to have taken exposure where we are expecting the value of the security to come down, right? So you benefit when the value comes down. That is not something we are planning as construct. That's just our choice and communication to investors. So let's be very clear on that. But I can't call the fund anything else because the regulator doesn't allow me. So it's called long short, but there is no short. Short can be zero, which is what it will be in our fund. The other flexibility is that we are allowed to have different redemption and subscription frequencies, right? So subscription is daily basis. Redemption, according to SIF regulation itself, need not be daily. It can be twice a week, once a month, once a quarter, once a year, whatever the AMC desires. And that we feel is a requirement of a fund, we can decide and propose that, and SEBI approves it, right? So most of the funds that have been launched twice a week, those kind of redemption frequencies. Apart from that, there is also a notice period allowed in SIF, meaning if you come to for a redemption to us, we will provide you the redemption after some number of days. I'll talk about it when I talk about our fund, but that is something that also, given the liquidity requirements of the fund, SEBI has said you decide how you want the redemptions to be funded. As I said, we want to provide a different product over here, and for that I'm just going to give a short history of fixed income product investments in our world. You see, 1990s, early 2000s, mostly people were into fixed deposits. There were no mutual funds, etc. existing over at that time. It started somewhere in the mid 2000s, where debt mutual funds came up. They were giving double-digit returns, right? FDs at that time, 9%, 10%, 11%, 12%. I think the highest rate, 2013, was 12% or something on fixed deposits. But over time, whenever fixed deposits have stopped giving those kind of returns, it is other categories which have gained. Because people who had surplus money and wanted to keep money safe were willing to look at other avenues other than fixed deposits, if they were not getting a decent yield from their deposits, which is probably the case even today. So you have fixed deposits at what, 6.5%, right? So things gradually changed on the risk profile and on the return profile. At the risk profile, it kept going a little bit up, because I would say fixed deposits of AAA banks, PSU banks, you would have debt MFs which will have a AAA portfolio, but I would still say it would be slightly higher risk compared to a fixed deposit of bank. Then it went into credit-oriented funds in 2018-19, where a lot of money moved into the various large fixed income allocations. And then the move after the post-2023 tax changes into a completely different segment, which is AIF, because investor possibly was looking at that 3, 4, 5% higher inflation-adjusted return. He was not looking at too much, but after tax and after expense, he was looking at that kind of a bump to his return, and he was still not comfortable doing equity allocation, right? That actually is the way in which investors have moved. This is a look back analysis. Why did the investor have to do that? Post 2018-19 crisis, in terms of the fixed income markets as well as COVID and other challenges, you had one large AMC facing various issues, because of which it percolated into the entire industry. So there became a huge risk aversion to credit. And apart from that, regulator also did so many changes. They brought liquidity framework requirement, they brought restrictions on various things, they made a lot of disclosures necessary. They made just so many changes in order to protect investors, such that I wouldn't say worked in a bad way, but it worked in a controlling way for an investment manager to possibly deliver a higher return to the investor as well, because those were constraining factors. And then the daily redemption which you had on the credit risk fund, for example, if I get a redemption at 2:30 and I have to fund it on the same day, credit exposures don't have that kind of liquidity in our Indian market, which is where the whole crisis in fact actually started. So that, and then 2023 you had indexation benefit gotten taken away. So fixed income investment in India has become a very difficult thing, where your returns have got significantly impacted, right? You are getting taxation benefit of indexation, 10 to 12% was your ultimate tax. You straight away get into 30% if you are an HNI. In fact, you're in the 39% bracket, right? You're 30 plus surcharge and cess. So that is why that person will make a beeline towards where can I get 13% gross return so that mera 7.5% net bane. That is where I think a lot of investors move into a very risky class compared to where they used to be before. AAA index funds were giving 6.5-7% kind of a net of tax return. They went into AIFs and hybrid seeking that kind of returns, right? So you see what has happened to our industry. Our credit risk funds, 72,000 in 2018 is now under 19,000 in terms of size in AUM. And wherever mutual funds were doing credit, combined AUM would have been almost 1.5 to 1.5 lakh crore or so. Not just credit risk fund. I've just used credit risk fund as a symbolic representation here. Even that has contracted. So the other things have also contracted. But look at the Cat 2 AIF space. It was 33,000 in 2018. It's now nearly 3 lakh crore. Money has moved in that direction because people want that final yield in their hand to be higher. What they do not understand or may have not seen is what they are getting exposed to, right? So credit risk is genuine, it is real, it has played out in the past. It may not play out for 6 years, 7 years, 10 years, but it will eventually play out. You have rating agency default rates where the alternate categories invest in BB kind of names being significantly higher, multiple times of what is the risk involved on the credit side for a AA or a space, right? So this kind of exposure is not known to the investor. What the investor compromises when they invest in Cat 2 AIFs, for example, is liquidity, because they don't see their money for 4 years, closed-ended funds hote hain. They don't know the underlying credit risk that they are actually taking, because if a risk were to play out, you will see when the event plays out in the future. We have had 6, 7, 8 years of great history. A few handful of events have happened, but they have not led to any significant impact on the space. But it has heated up, right? The space AIF has heated up. A lot of AUM has got gathered. So that risk is what people are getting exposed to, and that is where we feel there's a product gap. Can we place a product which is addressing this gap? That if you are a fixed income investor and you are getting constrained, but you are having to go from all the green category to the red category, can we put something which is in between, which addresses that gap on net returns and also doesn't expose you to the risks? So that is where we have slotted our product. If you see the return to risk chart on the top line is actually representing a gross yield target of the fund or likely to get of the fund, and the arrow that brings it down is the tax impact. I mean, it's just a representative chart, nothing to scale or anything, but the Cat 2 AIF sits in that space. Highest gross yield, actually 13 to 14% is what I am comparing with. Some people offer 18, 20 and all that also. It's a completely different space. Then the impact of slab taxation, right? So slab of 39% tax, your returns come down significantly. This product, by being in the hybrid category, is actually going to give me tax advantage on the fund as well, because it will be taxed at 1 year 12.5% LTCG equity taxation. So the negative impact of return is not going to be that high, which means I end up at a net level which is almost what an AIF otherwise would give, while I'm not sacrificing so many other things on the risk, right? So that's the benefit that this fund is going to draw. In order to achieve that, what are you going to have? Minimum 35% has to be allocated to arbitrage. That's a minimum, because I need that for the tax structure that we are targeting. Now I'm also allowed to do REIT units, because REIT units are classified as equity, relatively stable, not like a long equity exposure. Again, we are not looking to do entire 35% REIT or anything. It is just we have kept a sleeve. Up to 10% dekhenge. If we feel arbitrage today is giving somewhere around 7.5% kind of a annual return, right? If REITs, we feel, who give a distribution today of anywhere between 5.5 to 7%, will beat that target, because on a REIT, You also have NAV appreciation that happens because it's a real estate, and typically value of the real estate also goes up over time. So the price of REITs also gets appreciated by 3% or 4% a year. You have distributions of 5-6%, you have appreciation of 3-4%, typically 10, 11 to 12% kind of return ban sakta hai if you choose the right opportunity, right? So we have kept a sleeve for that. We want to generate some alpha for investors over there as well. The balance 65% is debt and InvITs. Right? In debt and InvITs, we have kept a 15% liquid security sleeve. I need this because there is some margin requirement for doing arbitrage as well. About 5-6% usme se that will be that, and the balance 10% will be left as permanent liquidity in the fund, which we will keep to maintain in case we have to fund redemptions whenever we will have to, right? So this portion of the fund, which is 15% and 35%, is the safe, secure, less volatile, steady earning kind of a segment. The balance 50% is where we are targeting a bit of alpha. Sorry, just breaking up the whole thing again, is the same 25 to 35 arbitrage, up to 10% of REITs, and AAA GSET up to 15%, and the balance 50% is the debt exposure. Here we are targeting median A rated, A to A plus rated exposures, right? I have to do two sectors, non-financial I can do up to 25, sorry, financial I can do up to 25, non-financial there are various sectors, we'll have to do 25 in non-financials. And within non-financials I can also look at InvIT unit opportunities. InvITs today are giving distribution of more than 10%. A category, A plus rated papers are typically in that 10.5 to 12% kind of a yield range, depending on the name and depending on the tenor and everything. So the target from this segment, where financial service also we are breaking into bonds and PTCs, is going to be targeting that kind of an yield, right? So idea is keep a breakup between PTCs and bonds as well. PTCs bring down my overall duration on the fund, right? I want to keep the duration around that 1.5 year mark, because we don't want to, at this point in the rate cycle especially, the idea is to keep getting money back every month, which PTCs allow me to do, and keep reinvesting that if levels are better. Because there may be a question, we are in the upward facing rate cycle. Number one, duration of my fund is very low, so rate cycle doesn't impact me that much. Number two, I'm into credit exposures, so rate cycle movements generally don't get fully translated into credit exposures because there's more things at play over there. And number three, I have a reinvestment section in the fund as well, which allows me to deploy capital again, because InvIT will give me distributions, REITs will give me distributions, PTCs will give me distributions every month or every quarter in InvIT REIT, which I will redeploy at those prevailing rates. So that's where the whole construct of the fund is. Once again, just to overall highlight, half of the fund is low risk, stable return section, half of the fund is alpha generation opportunities. When I say alpha, it is over and above what my low risk stable return is generating. So hypothetically, if that were generating based on current 7.5 index yield on the arbitrage, idea is to generate about 3% more from this particular section. I already mentioned where the category yields in the market currently prevail. It's part of the deck. So the exposures we are targeting, we are anywhere between in that range. And there is also a huge spread compression possibility, right? So capital gains are something that we are targeting. We enter into a fixed income deal at 11.5% yield. We hold it for 1.5-2 years. During that period, if that credit improves, which typically it does, in our case, we've had a lot of upgrades, almost 5-6 upgrades every year in our portfolio, which brings down the expected yield. Then you make capital gains on it, which is where our A category portfolio will also help, because most of the people we are targeting, 40-50 names, are entities which have a good amount of track record of history. They have established their proof of concept. They have a very good net worth position. They have seen investments come from PE funds, etc. They are looking to get into an IPO maybe in 1 to 2 years. Some of them are already listed. Those kind of names. And this slide has a back testing just to show that if you see the components of my fund are 15% AAA, which is my liquidity sleeve, 35% arbitrage, which is the second column, and the third percent is a category like exposure, which is 50% of the fund. So we've just made a composite index using these three index to give an idea of what a backtesting return could have generated. So rolling returns of every day for 12-month period over the last 2 years is what I have considered to calculate this average. So a corporate bond index A2 has generated 733, arbitrage 747, and the A index is at 1178. Right? When you blend this in the 15, 35, 50 combination, you achieve a 9.61 rolling return, average rolling return. Minimum, maximum is also there, just to take a look, and volatility of that on a standard deviation basis also there, just to take a look. The key impact is this right side, right? So if you see that index 733, because of the slab taxation, the post-tax return falls to 447. If you see the arbitrage, that gets taxed at 12.5, so the impact is less. And then the A category, again 39%, the impact is high. 1178 falls to 7.2. On a blended basis, my 9.61 falls only to 8.17, because this combination is going to be taxed at 1 year equity taxation. So we are able to generate a decent return when we deploy this strategy and get the benefit of the tax efficiency, which is why we have put the hybrid fund. Now, there are few slides on credit research process. I'll spend just few seconds. We have very long history. As I mentioned, we are managing 6,500-7,000 crore during the 2018-19 period of fixed income credit funds. We have an internal process. We don't do credit underwriting on the basis of external ratings. Our internal fundamental analysis goes long back. We have no defaults, no let's say even downgrades in my portfolio over the last 6 years. Not a single rating downgrade in my portfolio. We have seen 5 to 6 upgrades every year. We use an early warning signal process. It's a daily, we have subscription to various news feeds, and all of our names are tracked on that basis. Every morning, my team does a whole check of all the names that we have in terms of any negative developments, which is where we will take action on internal ratings and then take a call on what we have to do with the papers, if at all there are any. As I mentioned, historically, we have managed that kind of credit book, 6,500 crore. Today, these funds are still live. There are no issues in these funds, but the funds are contracted. They are about 1,200 crore only, because if you see, as I mentioned, the tax impact on the return is very high. And this is the main features of the fund. I will draw your attention to 3 important things. Number 1, there is an exit load before 1 year, 2%. The main reason for this is, obviously, we don't want anyone to come for a short parking of funds. Right? This is supposed to be treated as a long-term investment opportunity, at least a 1 year investment horizon. If you go before 1 year, you are anyway losing 25% on tax, because you fall from 14.95 overall on the LTCG to 39%. So 24% you are losing because of the tax benefit loss. You will lose another 2% because we don't want investors to go out and hit the existing investors. That apart, the liquidity is available. If there's an exigency and you have to go out, you have to go out, right? But the exit load is kept to keep investors for at least 1 year, and don't use this product as a 3-month, 6-month parking, right? That's not how we want to structure the fund also. The second manner in which we are going to prevent people from doing that kind of a approach, because there may be some people who will say that gross return decent, let me park for some time and I'll exit. So sorry, but we have kept redemption only on Monday of every week. You're not allowed redemption every day. And even if you come on a Monday, we will not pay you on a T+1 or a T+2 basis. We have kept a 10-day notice period. I did talk about notice period in the beginning. SEBI allows a notice period up to 15 working days in SIFs. We have chosen 10 working days because we think that's a reasonable time. If you come on for the redemption on Monday, you will be paid on the 10th working day's NAV. And to make it simpler for you, if there is no public holiday in the next 2 weeks, then it will be the Monday of the 3rd week, right? Because 10 working days. Monday to Monday is 5 working days. Subsequent Monday is 10 working days. If there's a holiday in between, The subsequent Monday will become Tuesday if there's a public holiday in between. And that will be the NAV date. The payment will be done on T+2. So the NAV of the third Monday and the payment will be on Wednesday. So you don't lose the accrual for that period, for that entire 14-day period that you asked redemption but didn't get your money, you have earned, right? So that's the broad 2-3 things on the characteristics of the fund. Our CIO fixed income, Shriram, is the fund manager. Our CIO equity, Venu, is the fund manager in the fund. This is a very important fund category. We feel there's a big gap in the market. Hence, all our big shots and important people want to see the future of this fund and growth of this fund. This is the main team. That's my team. Credit is a very important part of this fund, and yes, that is why I would say I have a very big involvement, and my team has a very big involvement in this fund to ensure, and we play two roles between Shriram, who will manage the fund as a fund manager, and me, who will be looking at all the credit exposures and the exposure that we do to generate that alpha. We will have a very key role in terms of what we will do and what we will not do, and have veto on every decisions whether to buy or not. Yeah, I think broadly that to conclude, accrual benefits, different category than anything that you would see on a regular basis nowadays, even being offered on SIF space. Fit for all seasons. There's no market volatility component as such. Some volatility is there because of REIT and InvIT, but I would still say that is not like a long equity exposure kind of volatility. It is fit for all seasons, I would say, and I think it will also have negative correlation to equity market volatility. If you have 2 years of last history, backtesting would give you around 20% or so kind of a return. Equity market may not have given you a very good return over the last 2 years. So there will be periods. People should look at their core asset allocation and think of allocating some portion to a strategy like this so that they have some stability of their wealth.